What if you could invest in a hard asset like silver and then earn a return in that same asset, bypassing the fiat dollar system entirely? Now you can. Monetary Metals has made a name for itself by generating a yield on gold and silver for their clients over the past 8 years and counting. Now they're offering the first silver bond in almost 200 years with a 12% annual interest rate paid in physical ounces of silver. Available to accredited investors only, investors in the bond receive a fixed 12% coupon on silver paid in physical ounces of silver, plus any silver price appreciation. Over half the bond has already been sold, and the remaining allocations are going fast. Do not miss being a part of this historic offering. Protect and grow your wealth in an asset that has stood the test of time. Secure your spot at realvision.com/metals.
Welcome to Real Vision. I'm Ash Bennington. Today, I'm joined by George Goncalves, head of U.S. macro strategy at MUFG. George, welcome back to Real Vision. Always a pleasure to have you with us.
Great to be on. Always great to be on with you, Ash.
Listen, I'm excited about this. We were talking a little bit at the break about SMEs, small and medium-sized enterprises, the impact they have on the U.S. economy. Before we get started diving into the thesis, George, give us a little bit of context on last week's rate cut. Tell us the significance and how you see it impacting the outlook for the U.S. economy.
No, so look, last week's move by the Fed, I think, was historic. It was a preemptive, larger than expected 50 basis point cut. Just for the record, we were one of the few houses that had that 50 basis point call. I mean, the majority were expecting 25 basis points. We changed our view in August and maintained our call through thick and thin. Throughout the big moves and probabilities of that first cut. We thought it was the right move. We heard from Chair Powell as well as various Fed speakers up until that actual meeting, where the language sounded as if they were pivoting. They were concerned and getting more increasingly focused on the cooling in the labor market. And so it made a lot of sense for them to make that first move 50 basis points, because they're looking at the totality of the data. Quite frankly, I think there's some remorse. They probably should have cut 25 in July. I think they're looking back and realizing that they missed that window, which has led to the larger cut. But it's the first time that we were really seeing the Fed being preemptive on a labor market. Meanwhile, inflation hasn't hit their target yet. It's on track to hopefully do so. But I think that the fact that they're trying to get ahead of it, it's almost like a little bit of like Minority Report, trying to think into the future, trying to soft land the U.S. economy before even having evidence of a real weakness taking hold.
Well, we're not going to commit any pre-crimes here on this conversation. But George, let me ask you this, because you're absolutely right. The consensus opinion was for 25 basis points. I think some of the surveys out there were skewed at like 90-10 in terms of 25 versus 50. You guys absolutely got this one right. Let me ask you this. What was it that you saw in the balance of risk in terms of inflation versus job growth that you saw and believed, boy, this is a period where the Fed really needs to cut basis points, as they in fact did, now to 475 to 500?
Yeah, absolutely. So we've been building on this story and documenting it for the better part of a year, that the data hasn't been matching up between various components of the labor market. So there's been, this has been, well televised, but a lot of shift from full-time job to part-time jobs. The fact that the household survey has disconnected from the NFP establishment survey, and the fact that nearly almost every single NFP gets revised lower after the initial release, 1 month later. In a truly robust and healthy economy, you should be seeing upgrades to job growth, because it takes time to kind of capture things. The fact that we always saw downward revisions, and the big one was the QCEW that happened, in the days before the Jackson Hole event, which I think really was the eye opener for the Fed. They realized that 818,000 jobs, never really took place, and that has a huge impact, across spending and income tabulations. So I think it was like, again, the totality of the data was getting us to the point where it was so abundantly clear that the labor market is not as resilient, as robust as what was being televised. And that was why we held that strong view that they should start off with 50. And also, the larger you do initially, the more you do it initially, maybe you could do less later. So there is a benefit of coming in strong with larger cuts.
You want to unfuck your shit?
This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Yeah. Of course, that's yesterday's ball game. Important to set the context, important to set the table for what we're about to talk about today, which I'm really interested in, which is SMEs, small and medium enterprises. Look, a lot of the data that we follow here in the United States is about big business. Talk a little bit about SMEs, talk about their size, their scope, their relation to the US economy, and why you do or don't think that that may be potentially a swing factor in where the direction of the US economy is headed next.
Sure. Maybe we can pull up one of the slides on my deck. Slide number 2. I think we have it in the background, where this has been a kind of key feature for my view, that comparing SME all in kind of cost from an interest expense perspective relative to the IG market, large U.S. corporations. So what you're seeing here, the red line is from the NFIB, kind of small business average interest rates on short-term loans. You consider that like working capital type loans. If you're starting up businesses or trying to expand your business, small businesses usually still get most of their credit from the banking system. And I'm going to come back to the banking system in one second. And then you have the black line, which is comparing and highlighting the all-in yield for the IG, investment grade, U.S. Corporate index, which is largely corporate America, right? So corporate America, after the initial rise in rates in 2022 into early part of 23, basically rates have gone sideways. Spreads compressed, even though rates were rising. So you had all-in costs between 5.5%, really favorable. Basically, corporate America was borrowing close to the Fed funds, right, without really any sort of penalty. And that's really the benefit of the capital markets being deep. A lot of liquidity still out there looking for yield, but it didn't translate into small businesses. And that's the red line going up and diverging. Why was that the case? I think that's the key to this whole picture.
Yeah, and let's talk this through and let's walk through this because when I saw that chart, this was sort of the amber lights that started flashing for me. Let's walk through what we're seeing right here. If you look there, the black line is what the cost of capital that large businesses are paying. The red line is small and medium sized enterprises. Obviously, you can see it's consistently been higher as you would expect. There's been a spread there, but that spread is widening right now pretty considerably, and the numbers, boy, they're getting a little dizzying when you're looking at about 8%. This is a pretty significant number for small businesses to bear.
Yeah, I mean, it's really somewhere between 8 and 10%, and some obviously pay more, some pay less. And the key thing here is like, look at when that wedge really started to diverge. It was in the early part of 2023. What happened in the early part of 2023? We had some large U.S. banks, go under. We had a lot of pressure in the regional banks, and the regional banks, in my opinion, became much more risk averse, and their availability of credit to the broader economy got curtailed. And by extension, that means that small businesses also probably were not receiving as much credit as they probably wanted to. And I think that led to both the cost of capital being much higher, so being translated through the higher interest rate channel, and less credit availability means that small businesses were probably not growing as strongly as some things like the NFP were suggesting, and maybe overestimating, as we're seeing now that perhaps there was an overstatement on how much job creation actually took place, because small businesses are still nearly half the economy, but really folks don't really focus on it because they're not part of the broader financial system in terms of capital markets.
Yeah, and for those who may be wondering, NFP is non-farm payrolls. The other acronym, QCEW, is the Quarterly Consensus Employment and Wages. These are some of the major reports that come out from the BLS, Bureau of Labor Statistics, at DOL, Department of Labor. So there's your acronym soup for you this morning.
Yeah, thanks for clarifying that. Always important.
Yeah. So here's what's so interesting to me about your work and its implications as we look at the broader economy. A 2023 story that maybe some folks have forgotten about is the collapse of Silicon Valley Bank. You and I were talking about this before we went live. And of course, the several other banks that failed around the same time. There was not the domino effect that many had feared coming off the collapse of Silicon Valley Bank. And this is why it's important about talking about it right now, talking about the availability of credit, what it meant for other regional banks, small banks trimming their sails in the wake of those failures to potentially impair the ability of these small and medium enterprises to receive credit. This is a story that just is not getting enough attention. And clearly, when you look at your charts, you can see the impact there in terms of the weighted average cost of capital that these enterprises, these businesses, mom and pop shops across America are paying right now.
Yeah, and that's another reason why we've been so adamant that the Fed has to cut rates. There is not one size fits all interest rates for the U.S. I really wish there was a much more nuanced and targeted way of distributing rates across different industries. But the Fed has a very blunt tool, and it's that one rate policy and or the balance sheet, which hopefully we don't get back to, and using it in terms of QE. But it's really just the rates channel that they have, and it has impacts on different interest rate sensitive sectors in the economy, and because while there wasn't any sort of financial cracks that took place after that initial shock of those bank failures, the markets basically ignored what was happening under the surface, which was less credit availability to the economy, and it was easily masked by two things. One, the Fed did launch the term bank funding program. So there was a liquidity vehicle that was provided for banks that needed excess liquidity. So that was addressing this near-term concerns about just bank liquidity. And the second thing is, in general, post-pandemic, and at that time, still in 2023, there was still a lot of savings and excess liquidity in the system, which allowed for spending to continue and for just for the economy to operate without that additional credit channel being fully open. But if you look at the next chart, chart 3, this is comparing bank credit, and taking out the security side, because this is important, and I'll tell you why. And then looking at it from real terms, because we lived in a nominally inflated, higher environment, so you have to really adjust for inflation when you have these sort of shocks. And if you do so, real bank credit is still kind of borderline, not really growing, and it's been about a year and a half later since we've
Let
had these.
let me just explain this because I want to make sure I'm getting this right. When I saw this chart, it was one that I found really, really interesting and really, really compelling for a couple of reasons. So first, this is extremely long time horizon. If I'm reading this correctly, it's going back some 80 years. So you're really looking at credit growth over a very long time scale. This is giving you a sense of credit availability throughout the U.S. economy for a very long period of time. Number two, I believe, if I'm understanding this correctly, you're subtracting out all of the securitized uh, lending. So this is essentially just a pure bank lending chart that you're looking at, probably very relevant to small and medium-sized enterprises who do not have access to the public debt markets. Incredibly important point to make there. And number
Yes.
three, black versus red. This is in nominal versus real dollars. Boy, this is a great chart to understand what's happening in terms of bank lending credit availability, particularly those small and medium sized enterprises. Tell us what it shows right now, because when I see that red line below the origin, below the zero mark, that's a concerning sign.
Yeah, and so let's yes, many folks I'm sure are aware of the Fed's H8 data, which is where this comes from. What I did here is very simply stripped out the securities book, because the securities book has what saw a pretty big hit for those that were available for sale that fed through on a mark to market basis. And so that data is represented in mark to market perspective. And so in 2022 and 2023, as the Fed raised rates, these bond portfolios, started to go down in value. So they went from, let's say, par of 100 down to 80 cents. That's 20% loss, right? So you have a natural contraction of your book because you're actually seeing your portfolio shrink because there's losses, right? So you have to subtract that out because it works in both directions. Because now bonds have rallied in the past year. It would, if you look at bank portfolios, it looks in bank credit as a whole for the system, it looks like it's growing. But all it's really doing is that the book is curing. You're seeing values kind of get pulled to par. So you're just seeing a natural return of the portfolio, losing less money, and so it's actually up 5 or 10%. It looks as if bank credit is growing, which is also one of the reasons why I think a lot of people get M2 wrong, or even though this doesn't feed into M2, but this idea that banks free lending again and there's an upsurge in liquidity, I think they're kind of confusing bank credit, which is the top of the summary of that Fed report. It's really improving because the bonds are back up in value, not because credit is growing. And the only real channels of credit growth are in these really esoteric areas, but you don't see it. You don't see it in commercial and industrial, which a lot of that will eventually go into small to mid-sized companies. You're not seeing it in real estate either. So we're not really seeing the credit channel open, and that's why I subtracted out from the total bank credit. And if you look at it on a real terms, it's still negative. So that's the red line, or close to negative. It's kind of like borderline, kind of popping back up here, but it's been depressed for such a long time. And historically, whenever that happens, it's usually in a recession or right before a recession. Going back historically, we've only had a few times where in the 1974, if you look at that kind of dip lower, 1973, 74, on a nominal basis, it went negative, and also very much so in real terms. But and then there was that 1990s post savings and loan crisis, but the recession already happened in 1990. So it usually is around the recession or like before one comes.
So let me ask you this. Talk a little bit about this word that you use. You said esoteric, and it's an interesting word here in terms of what it means for your view of the economy. I remember post global financial crisis having an off the record conversation with the CEO of a very large public company here in the United States, and he said, "What you don't understand is that the economy is divided into two different sections. There are guys like me who have access to the public debt markets. For me, it's Candyland. I can go out and buy whatever I want, and then there's everybody else." And that really struck me. And when you talk about this idea of subtracting out some of the esoteric products, subtracting out some of the securitized lending products, when you're talking about C&I loans, commercial and industrial loans, the loans that small and medium-sized enterprise get, what does that mean for people who are trying to run these businesses? And what does it mean for job creation, where a lot of that swing factor in the U.S. economy comes from these small and medium-sized enterprises?
Yeah. So look, if the small to mid-sized firms still get 80 to 90% of their lending credit availability coming from the banking system, if they're not able to get as much credit as they used to, or the cost of credit is a lot more expensive than it is in the public markets, means that you don't expand your businesses as much as you would like to, and therefore you hire less people. And that's why as I said at the start, this kind of like squaring the circle around what has been an overstatement of potential job growth in the U.S. is that the NFP, the non-farm payroll report, has this thing called the birth-death model, tries to kind of capture how many companies are being created or destroyed or just going out of business. It's a kind of very morbid way of calling it the birth-death model. But that thing has been, I think, one, it's been skewed ever since the pandemic, and they've been having a hard time calibrating it because of like the big swings and shutting down businesses, reopening businesses, and how much true innovation and new companies actually came to be post reopening, and then like how much continued after in 23 and 24. I think that model's been flawed, and so they've been estimating too many small business job creation, which is why we always see this constant revision to the jobs data. And I think that's why I think the Fed has finally come to this conclusion as well, which is why they realized that rates at at 5.5 were way too high. Even at 4.875, they're still 200 basis points higher than their own neutral target, which means they're really far behind.
All right, let's take a look at the next slide.
Yeah, so I mean, like this is something that just kind of looking at, and it's been also pretty much well documented. But if you're not being able to source capital and credit easily or in a cost efficient manner, the risk of bankruptcies go up, and so we are seeing a pretty big increase in bankruptcies here on the chapter 11 as well. There's been less in 7 and 13, but still decent upswing. You can say that it was maybe depressed during 22, coming out of the pandemic, and there was a lot of firms that were either flush with cash and trying to stay in business as long as possible. But perhaps that's why we're seeing a makeup it's again, it's not alarming yet, but it's more the level's not alarming yet. But it's the speed and the change in direction that's probably the most concerning.
Yeah, and by the way, I should say that origin, that data down there. So 7 is liquidation, 11 is reorganization, Chapter 13, probably the least understood. This is a so-called wage earner bankruptcy that allows small businesses and small proprietorships to reorganize their debts over a 3 to 5 year period. George, what looks striking to me about this chart is where you see that very steep rise around the global financial crisis. That's the gray bar that you see there. The gray bar that you see to the left between 2000 and 2002 is um, the short, shallow recession following September 11th. Boy, it's really compelling to see, particularly that Chapter 11 number rise so steeply without a gray bar, meaning not in a period of recession.
Yeah, exactly. So it's look, it's that's why I think there's been a lot of debate and consternation about, are we heading into a recession? Have we already been in one? Are we going to see even further revisions to the data and realize that perhaps we're in the midst of one and or very close? I think that, all of these unknowns have been made more difficult to assess and discount because of the nature of where we started from, with all this pent up liquidity and all this injection of fiscal money into the system. It really just kind of masked the reality, in my opinion. And I think now we're starting to get to the true macro backdrop of, like, how sustainable is the U.S. economy's recovery? Is it going to continue? Is 5% the right level of interest rates? I mean, I know that you speak to a lot of different forecasters and strategists and economists over the course of the year. I mean, there was a whole group of folks that were in the no landing camp, the soft landing camp, you know, plus, right, which is that not only are we gonna not have a hard landing, we're gonna somehow take off from these levels. And I was like, how can we take off from these levels when interest rates are at the highest they've been in multi decades? It's really choking off credit. Like, where's that growth going to come from? But the good thing for, I think, at least at this point, we can at least kind of say, rest assured that the no landing idea has been thrown into the dustbin, because you cannot have no landing without low rates. You need lower rates to get the economy to really get back online. And you're seeing it, even with China's rate cuts. Like, the global economy, especially the U.S. economy, cannot handle high rates for long periods of time. That's why the Fed has to keep cutting.
George, let me ask you this. I know we've only walked through 3 sides. We've got a full deck to walk through. I'm sure we'll talk about this more in the end.
Yeah,
But I
yeah.
just want to orient people in terms of the practical application of the research, in terms of not just forecasting future economic activity and inflation, but also what this implies right now for debt markets, for risk asset markets more broadly. What is your interpretation of what's happened, how the bond markets have reacted to this here in the US? And if you'd like to talk a little bit about equities, of course, we're always interested to hear that as well.
Yeah, and look, let's talk a little bit about markets, and we'll get back on the deck, and we'll pick and choose a few slides that I think will back up this idea. The the bond market in general, usually people kind of ascribe the bond market is the smartest macro kid in the room, right? And you kind of get this. We were off in 2022 and 2023, but now we're back on our stride, and we've realized that rates cannot stay elevated. So it's no surprise to the bond market. I mean, rates have been rallying all throughout this last year or so, especially in the last few months. And this is where it becomes challenging, because now we've basically priced in a lot of what the Fed will likely deliver as part of their normalization towards neutral interest rates. In other words, like, if you look at the forward rates, if you look at like the 2-year Treasury, the 10-year and the 5-year especially, they've rallied a lot. I mean, we're still over 120 basis points, or roughly 100 basis points under the Fed target. They cut 50, but it was kind of a little bit anticlimactic, because the market's like, yeah, we know you have to cut more, because we're expecting rates to go into the 3 handles, into the 3% range, and you're still close to 5. So you have a lot of kind of wood to chop. So the bond market already priced this in. So this is going to be difficult from this point forward until the Fed delivers on more cuts. So if they start cutting further and getting deeper into the low 4% range, down to into the 3s, that starts to justify the valuations that we already see in the bond market. So that's one point of view. And the other one, which I think people kind of forget, is that pivot that took place basically almost a year ago, after we saw the rise in rates in September last year. The 10-year got close to 5%. We saw the big pivot in November around the refunding, with less supply out the back end of the curve and more T-bill supply from the Treasury, and the Fed basically acknowledging that they're on hold, that they're no longer hiking after the November meeting last year, and then the Powell pivot in December created a massive risk on, which has been kind of carrying through all of 2024. I mean, we've had minor pullbacks in risk markets, but in general, we've seen an upward swing in the stock market, right? And rates have kept going lower and lower and lower. So I think the two are related. The bond market was easing financial conditions already. So now, even if the Fed delivers on the bond market, there's no additional financial conditions easing going forward. And I think that's what's lost upon a lot of the folks in the risk markets, that it's already happened. The easing took place. And in fact, actually, you might have a risk that rates go up as the Fed is cutting rates over inflation concerns or whatever the case may be. But the 5-year, 10-year part of the curve might not rally as much going forward. And that's not going to help out credit, it's not going to help out mortgages, it's not going to help out the housing market, and it's not going to help out the stock market either. So basically, it's all priced in.
Okay, that is really, really interesting. And I want to walk through it in some detail, particularly for people who don't follow this as closely as you do, George, because these are some really, really important points about what's going to happen, in your view, to U.S. Risk asset prices. To your Treasury right now, trading at 3.55 on my screen, 10-year, call it about 3.75 or thereabouts. One of the things that's interesting here is we have this disinversion of the curve. 2's 10 spread right now at around 20 basis points, 19 bips on my screen. This is the first time in some time during this cycle that we've seen this positive 2's 10 spread going back to 2022. It's really interesting to hear you say, hey, listen, what bond markets might be doing right now is pricing in those future rate cuts. As you said, lots of wood to chop from the Fed to get down to that terminal rate. This is really, really interesting because if the implication here is that these bond markets have already priced in those cuts, it really does, as you say, have implications for this idea that credit conditions simply may not loosen any further. This is really interesting stuff.
Yeah, no, and I think that's going to slowly come into the discourse over the coming weeks. But maybe go to page 14 if you guys don't mind sliding down and going into the market section, and we'll work our way backwards.
Let's do it.
Yeah, one more. Yeah, page 14. Yeah, so this is what people kind of in our industry call the hairline charts, and it's just basically all those little dotted lines are being superimposed on the black line, which is the Fed funds rate. So this is just what yield curves were telling us on a given day over history, going back into the 90s, and how does the yield curve project like where rates were going to be. If you kind of work from left to right, the bond market in the past was actually a very optimistic bunch of folks. We thought rates would always go higher. So in the 1990s, when the Fed had finished hiking rates in 95, they were almost projecting 8% on rates. Like that's what that little kind of curve was telling you. Even after the dot-com peak in 2000, the bond market was suggesting that rates were going to get close to 7.5%. We've never seen rates like that ever again. It probably won't unless we get into a massive inflationary spiral, but that's not the story for today. But in general, those little hairlines are basically yield curves that are suggesting where rates would have been had the Fed followed along with market projections. Look at what's happened ever since. Every single time we've had either a crisis or an economic slowdown, the bond market starts to realize, oh, after you finish hiking, the next move is easing. Like there's only so much time the Fed can stay on hold, and the clock starts ticking once the final cut is put in place. This was a long hold period, analogous to what we got in 2006, 2007 hold period. But you can see like the stronger burgundy kind of dots charts around 2001, 2007, 2008. The bond market starts to learn, it's like, oh, once you finish actual hiking and you're on hold, the next obvious move is further cuts because we can't maintain these levels of rates. Well, then you kind of move on to 2019. The same thing happened. And bond market kept pricing in lower and lower cuts, and eventually the Fed delivered on those cuts. And then even in this most recent, largest and quickest rise in rates from the Fed, all the while the Fed was raising rates, the bond market was pricing in cuts. Right? Just think about that. Like, so they're trying to tighten monetary conditions, and the bond market was easing while they were actually tightening. So the curves were inverted. To your point before, that the curve is disinverted for the spot curve on the Treasury curve. But for short-term interest rates, which is the domain of the Fed, that area of the money market space has had an inverted curve and still has an inverted curve. So that's the blue line towards the right side of the chart. You can see that as of the Fed meeting on September 18th, that solid blue line was almost the same level as when the Fed delivered its last 50 basis point hike. So the curve shape looks very similar to when they were still hiking and we were expecting cuts. So we've been expecting cuts for a long time. And now that the Fed has finally kind of moved in that direction, the question is what the bond market has priced in enough? And if it is, then the Fed will then get towards neutral because that blue line kind of the trough there is somewhere around 3%. But if it's 3%, I don't think it's going to be enough to engender further financial conditions easing because it's already been priced in for about 18 months. At least for the last 9 months for sure. But even while the Fed was hiking, the market was easing. I know it's hard to kind of reconcile that concept, but that's what
Right.
was being priced in, and that was the level of credit pricing that was afforded to large corporations because they kind of tee off of that money market SOFR curve.
Let's talk about this because it really is a big shift. I really enjoy these charts that go back some 30 years. It's really interesting. When we look back to the left hand side of this chart, you can see exactly what you said. When we are at the high point in retrospect of those cycles on federal funds rates, you saw those forward curves pricing in further rate hikes. This is going back to the days when I could run a mile without wheezing. Really interesting to see what happens here around the 2019 period where you see the expectation. Perhaps, I guess in hindsight, everything makes sense. It seems pretty logical. Hey, once we get to a certain level, the Fed's going to have to cut. But this is a major shift for the way that bond markets have worked for 30 years. What's the implication for this, George? What's the risk? Does this sort of imply that the Fed is losing its ability to guide markets, and that markets are being guided by this is sort of the tail wagging the dog? That essentially you have markets say, "Hey, we know you guys aren't going to be able to keep them up this high for very long. We're going to start pricing in on the forward curve of these cuts."
Yeah, and this kind of it's like a tango, two steps forward, one step back. It's going to be this give and take between markets and the Fed. In my humble opinion, I think it's also one of the reasons why, although their neutral rate, which is the long term dot for those that follow these sort of wonky stuff, the long term interest rate estimates projected in the most recent summary of economic projections from the Fed's forecasts, they moved up their long term expectations to 2.875. So, whatever, let's just call it 3% roughly. So, somewhere between 2.75 and 3% is what the Fed thinks is neutral. The market also agrees that it's neutral. And that might be the Fed drawing a line in the sand saying, look, we're not really looking to cut rates much more than that. That we're kind of meeting the market like at the point where we understand that the market's been calling for 3%. We've been keeping it at 5.5. That's been the wrong zip code. We're going to make a run towards 3. The question is how fast you get there, and and at what pace. Is it like in this kind of moderate 25 bip increments, or are they going to have to keep doing these large 50 cuts to get there quickly to ensure that they don't do further damage to the labor market? That to me is the only question that remains now. Once we get towards 3%, that's neutral. That's not even like accommodative, right? That should be like where the economy is not expanding or contracting or creating inflationary pressures. Once we get to that stage, then the question then becomes, does the economy need further easing? Or did they overshoot and maybe the neutral is even higher now because of the kind of we're embedding more and more inflationary pressures in the system? That's like part 3 where we can't even trade that at this point yet. It's more about understanding like can we get to 3%? How fast? And I think that the market has drawn that line in the sand and the Fed's going to meet it.
Yeah, this gets into this idea of the much debated R star, the neutral policy rate, how we know when we get there. Listen, let me ask you this because talking and hearing what you just said on the last segment, it's really interesting to me. This idea of lower for longer. It sounds like, potentially like lower forever. What happens if the risk is misjudged by the Fed in terms of this asymmetric risk to the labor markets? What happens if we see inflation beginning to crawl higher again? Have they lost the ability to manage that?
So I mean, what you described is stagflation, which is still a distinct possibility, and it's high in my odds. I actually increased our odds of recession back to above 50%. It's at 55. So I'm probably one of the highest forecasters on the street, still thinking that in the next 12 months, or maybe in hindsight, we're already in the recession. We'll see. But I think that we'd probably see a slowdown first, which is inherently disinflationary. People lose pricing power in terms of wages. People lose their jobs. So, like, I mean, that's the unfortunate consequence of overstaying and keeping rates too high for too long. But this idea of like higher for longer, I think we love narratives, obviously in the markets, and it's very convenient to package these ideas like these like catchy sayings. But higher for longer is relative. It's relative to like where we were before, and it's relative to what is the estimation of R star or the neutral rate. So if the neutral rate is 3, they have been very restrictive. Forget about higher for longer. They've been very restrictive. So, I mean, higher for longer for me is anything above 3. So if you're above 3, this idea of higher for longer is still consistent, and you don't have to keep tightening the price of money through like higher rates. Once you get closer to 3, then you're getting more towards the neutral, and then you can see if the economy either starts to heat up again or not. And if it continues to decelerate, that means that the long and variable lags have created enough damage to the underlying economy that they're going to have to go under 3. So that's why you can't set up for that trade yet. I think now we're in the period of markets are going to give the Fed a chance to see if they deliver on those cuts, and if we can actually get a soft landing. I'm in the bumpy landing category. They're going to try to soft land, but as we're doing it, it's going to be bumpy. We're going to get even further evidence of economic weakness. We have a real risk of some negative NFPs coming up in the coming releases, and that will really scare markets to realize, hey, maybe it's not as rosy out there, and even if the Fed cuts, it won't really change anything because the die's been cast, and so it's going to keep kind of decelerating until the Fed either cuts under neutral. But you can't set up for that yet. I think we need more data for that to get behind that view. So yeah, I think it's just rates matter. They always do. This when people start telling you that rates don't matter, which was another narrative that was out there that was driving me crazy. It's like rates are like the price of money. How could they not matter? They matter to different industries and different cohorts at different times and different regimes, but they still matter. Otherwise, why do we have rate policy to begin with, right? Why do we have these tools? So rates matter. Higher for longer is relative, and perhaps the Fed overstayed their welcome at high rates, and now there's going to be that long and variable lags working its way through the economy. They're going to have to cut faster to offset it.
George, I know we jumped ahead a little bit here in the deck. Maybe we should head back as we talk about rate cuts. I think the rate cut charts begin. Maybe if we head back to slide 9. We can take a look at this and walk through the labor market picture that the Fed was looking at, and then head into some of the MUFG analysis on rate cuts.
Yeah, so what we're looking at is just kind of job openings and the unemployment rate. And I think by now everyone's become familiarized with the whole SOM rule and the fact that we're seeing the short-term averages of the unemployment rate rising faster than the 12-month trailing low, and that is usually happening at inflection points in the economy. So unemployment rate rising is never a good thing. And there are folks that'll come out and say, well, it's because the labor force is expanding. Well, if we're not producing enough jobs for new entrants, isn't that a problem? I mean, those folks would like to get a job as well, and so then that they're competing for whatever available jobs are out there, and so you have a rising labor force, but not enough jobs being created. And then if you look at the job openings, which is the red line, that's been declining and has been declining ever since we saw the big increase post reopening, post COVID. When these two continue to operate like this, if we continue to see less job openings and higher unemployment and just overall hiring slowing down, you're very close to, if not in a recession. And so it's no one likes to say the R word. I know it's but we have to be just kind of like be clinical about it and just be objective and look at the data is telling you that something's not right with the labor market. And so I think this is what the Fed's also looking at as well. And then if you go to the next slide, slide 10, to kind of keep on pace with the labor data, this next slide shows you on page 10, there's been different ideas around what's the steady state, what's like the natural growth rate for the labor force. Let's just call it 175,000. I've seen estimates between 125 and 225. Let's just call it somewhere in the middle, that you need to at least produce this amount of jobs just to keep up with population growth and new entrants into the workforce. So let's call it 175. So the way to read this chart, the bottom panel, the black line is, are you producing more than the 175 or less than the 175? And since April, job growth has been under delivering. So we've been producing less than 175,000 average per month. We've been producing about 135. And that 1 July reading got revised lower to 89,000 jobs. So one of the really weakest prints for the year. But really, since April, there's been a downshift in the U.S. economy. So I think you can, and this is based on NFP data, by the way, which already gets revised lower because of the QCW thing, right? So jobs, at 175,000 is nothing to snuff at. It is a good, decent job growth. At least you're maintaining. It's not like super strong and pulling in or overproducing jobs, but at least you're maintaining the growth rate that's needed for the economy. Under 175, you're in deceleration mode. So something happened over the course of the last couple of months where companies have been pulling back on hiring. And a lot of this hiring, by the way, this includes both private and public sector. If it wasn't for the government jobs, healthcare jobs, and state and local government, we would actually see very little private sector growth altogether, which tells you the private sector has been offline for the last couple of months.
George, we're going to walk through some of the slides, the next 3 slides, about Fed rate cuts in just a second here. But I want to ask you something that may be a little bit outside your wheelhouse, but I just want to bring this into focus here. We're talking about potential impairment to the labor market, particularly private sector labor markets, when you do this net of federal, state, and local job creation. I'm looking here just at the S&P 500 trading above 5,700 on my screen right now. Year to date, plus 20%, trailing 12 months, plus almost 32%. It's hard to reconcile some of these points that we're talking about here. When we talk about impairment of the labor market, when we talk about shrinking credit availability to small and medium-sized enterprises, and yet you have a massive, it just increases in prices of U.S. equities far above anything that looks like a long-term average return. How do you square that mentally when you look at this and we walk through these data points? What do you think might be happening there?
Look, I'm sure are familiar with the good work from Michael Green. The whole passive flow. The stock market is not the economy. I think we have to. If this doesn't tell you that it's not the economy, I'm not sure what it is. You can have these divergences for periods of time. At some point they have to reconcile. Either corporate earnings have to increase or valuations have to come back down, right? So I think that we're in this sort of ambiguous state where we don't know. Are we going to see a pullback on earnings expectations, and then that finally gets translated into lower equity prices? I'm more in that camp, especially if they're not really expanding their businesses and growing further, and they're just benefiting from capital that's kind of very captive capital that continues to get reinvested into the equity space. And and the U.S. Markets do receive a lot of support from foreign investors, and so I think there's this kind of magnetic pull that's been driving flows into equities that have been self-sustaining for now, but the active managers really can't fight that flow, I think, and so it just kind of like this kind of cruise control kind of grinds higher until there's like a day of reckoning around the macro. We realize, our assumptions were really all flawed. The bond market's been telling us for a long time, screaming from the mountaintops that, hey, something's not right here. Fed delivers on it, and then the equity market has a correction. I'm much more in that camp.
Yeah, and it's interesting because sort of implicit in that thesis, whether it's hot money flows, international capital, our old friend Mike Green here at Real Vision, the passive indexation about what's happening in markets. The implication is, hey, this could continue to go on for some indefinite period of time before reality catches up.
That's right, or the demographics start to shift around it too, right? Because we do also have a lot of baby boomers that are at some point, having to tap into retirements. So again, this is going to be a flow driven kind of market until otherwise, and that's going to need the macro to turn in a very clear way. But when it's so obvious, it's going to be too late. That's the problem, right? It's going to be like once everyone realizes that there wasn't real economic activity that is sustainable behind it, that it needs really, really low rates, then I think that the story will get rewritten.
And if it does happen, it will be perfectly obvious in retrospect.
Always is. I mean, that's the problem. I mean, people want to have the evidence before the actual outcome, but we're in the predictions business, and it's the hardest one to do, right? You can't forecast the future with 100% precision. If you do, then everyone already has a trade on, and it's already priced in.
Okay, with that said, let's jump back in. I believe slide 11, looking at the Fed.
Yeah. So yeah, this is really just highlighting, and this is us trying to, as we were mapping out the last 50 basis point first cut, which happened in 2007. So that's the black line that you're seeing there. And we kind of superimposed what could have been events. And look, I was in the markets back then. I've been in the market since 97, 98. And I've seen different iterations of what drives markets. And I distinctly remember that 07, 08 period. It's ingrained. It's the PTSD that all us bond veterans have from that time period. But I superimposed some of the key events that took place that drove the black line's probability of a 50 bip cut in 2007. You go through a big period of time where in the summer of 2007, people really were banking on the soft landing. It's going to be fine. Housing is just a very isolated issue. You get into August of 2007, you get the first sort of indications that it's not just a housing story. It's a broader kind of call on the whole Eurodollar liquidity global dollar markets. And that's when you saw the black line started to move higher, when we saw the BNP funds having slowing down or suspending the redemptions. You had the Fed cut, an emergency cut in 2007 in August. And then the probabilities of the 50 bip cut dropped back down to zero, and then spiked around the first negative NFP that we saw in September of 2007. But going into the meeting, the market was not pricing in a 50 bip cut, and the Fed actually delivered a surprise cut. Whereas this time, the market, again, because we're getting smarter each time we do this, I think, and the market kind of saw the big yen carry trade unwind of August of 2024 now, and saw that maybe there is some risks out there that could potentially indicate that there's liquidity issues out there. We saw a big spike in the probability, as you see with the red line, nearly almost 100% of a 50 bip cut. And then it started kind of coming back down as the data started coming out, as we saw a lot of this sort of weaker hands close down on the yen carry trade. And then we moved back towards US macro narrative. How much will the Fed cut, 25 or 50? We went back and forth on that all the way up until basically the few days before the meeting, and the probability spiked again, but only to about 60, 65. So like usually the Fed likes to do a policy change, especially the first one, with a probability closer to 100%. So this was still a surprise in my book, because they cut when nearly 90% of the forecasters were calling for 25, and it was only a few of us that were calling for 50. It's still a surprise in my book, even though it was priced in partially by the bond market.
I remember those days in 2007 quite well. They're just these two obscure hedge funds over at Bear. Nobody cares. Jimmy Kane knows what he's doing. Everything's going to be fine.
Yeah, and it kept kind of unraveling, snowballing from there. We know the rest is history. And I think sometimes what confuses and confounds us is we think that what we knew in 2009, 2008 was already known in 2007. You had to go through the passage of time to actually really realize the gravity of the situation. So even though we look at these historical charts, we're like, of course that's what happened. It's like, yeah, but when you were living through it, it was not that obvious.
Yeah. Next slide 12 is interesting because you have a breakout, this election sidebar scenarios where you have a separate take on what may happen here with the different scenarios for a Harris presidency versus a Trump presidency. Really interesting stuff.
Yeah, so our view was for this idea of front loading. As you can tell, we think that the Fed should do more sooner, and maybe that could avoid them doing more less later or whatever. The more you cut, you can try to address the problem now, and you get a bumpy landing, but not a full blown recession, hopefully. But you got to start moving. You can't just sit there waiting on the fence. So our scenarios 1 and scenarios 2 are kind of split between the soft landing dreams, front loading, versus a missed window, bumpy landing. We're kind of torn between those two as our macro views, and then a small probability that they actually skip in November if we have a lot of election volatility. I don't think that's likely. I mean, we probably won't know who's going to be the winner of the election. It might take a few days. It might be contested. It might drag on for months on end, and so we might not really know definitively who's the next president. And so I don't think the Fed should skip in November. They should just cut at a minimum 25. But if that, if the next couple of NFPs are very low, in the 100 or sub 100 level, and maybe dangerously close to negative because of that birth death model bias in September could actually swing NFP negative, which comes out in October in a couple weeks. So we'll see if we get a negative NFP, that's going to almost lock in a 50 basis point cut for November. So that's like our base case view. And then on the right side, this is just hypothetical, and they're separate and aside from the general themes. But people always ask, like, if you get a blue wave or red wave, like what would the Fed's reaction function be? This is my first attempt at looking at that. I think it depends on if it's a surprise scenario. Was the market expecting a Trump win and then we got a Harris surprise, or vice versa? We got Harris was doing well. It has been doing well in the polls, and that continues to improve up until the day of the election. But then we get a surprise, and it's actually Trump that wins. Like, that's the way to read this hypothetical scenario. It's like, if you have a shock of a blue or red wave, what does the Fed do? I think in a shock full blue, so House, Senate, and the presidency, that gives a mandate for Harris to actually implement those sort of tax reforms that I don't think the markets are going to find friendly. And you can see a pretty decent risk off. And given that a lot of the wealth effect has been driving and tied back to the S&P continuously rising over the last couple of years, if you get a risk off and that wealth effect goes in reverse, that's going to slow down the economy because the upper income are doing a lot of the spending. So if you get a shock to the wealth effect from a blue wave, then that's the cut more, in my opinion. If you get a red wave, it's the Fed in general and most market practitioners view a Trump win as more inflationary, even if it's not the case, because we can debate that. But if that's the way the market trades initially on that sort of news and outcome, then the Fed cuts less. That's the simplest, easiest way to kind of distill those two scenarios.
Hey, let me ask you this. Listen, I generally avoid talking about politics like a plague on this show, but I have to ask you, when we look at the polling data, it's something that I've been doing kind of every day, just flipping through the polling data. I just don't have any confidence in these numbers. It does not seem like pollsters have gotten this dialed in. They haven't figured out the transition from landlines to cell phones. It seems like depending upon which poll you're looking at, they're just reaching different people. They just seem like they're all over the place. Do you have any faith in the predictive power of this polling data that we're seeing?
No, and not when it's like close to 50-50. I really don't assign too much confidence in one outcome versus the other. And I think the market doesn't either. That's why the market hasn't been reacting that much. I mean, during the debate, there was some concerns as Kamala Harris did, at least from the betting, the odd sites, and from the polling afterwards, looked like she did much better in that first debate. And the S&P actually went down during that overnight session. So that was probably the only real read of a kind of a connection back to near-term updates, connecting the political developments with market. But I think the markets have been focused on the Fed because it was a big, historic move, them being so preemptive with a big cut. And in the market, as much as we can try to suggest we can juggle a lot of balls at one time, a lot of times the market becomes very myopic on one macro theme and then moves on to the next. And I think we're now at that point where we're going to transition towards really laser focused on what the election, what's in store for the election. Is it going to be a clear victor? Is it going to be a drawn out process? But the market, I don't think, has been really reacting to political developments yet.
Yeah, I think that's well said. Okay, lucky number 13, slide 13. This is an interesting one because it shows the absolute trajectory of rate cuts during cutting cycles, sort of agnostic of where the levels were when they began. You just see the cutting here on the x-axis. You've got the months charted.
Yeah, the big takeaway from this chart, every cycle is different, first and foremost. And so, in the 70s and or in the 80s and 70s that were really sharp rate cuts because they had hiked a lot before. So when you're hiking 1,000, you can cut 1,000. So that's why you get these big sort of swings. But once we got into the more steady state, great moderation, post 1990s, lower rate environment, all else equal, rate paths have been shallower, rates have been lower, all else equal too. But most easing cycles tend to get wrapped up in 1 year's time. So if the clock now has started in September, by next year, September, the Fed has basically finished its easing cycle. So that's why, if you look at the dashed red line, that's the market forward rates, which are roughly about 200 basis points. The black line is the average, which is being skewed a little bit lower because in the last few easing cycles, the Fed has cut, 2019 aside, because they didn't have enough room to cut. They only had 250 bips to be able to go down to zero. But in the last couple of easing cycles, they cut 500. So, and they have room to do 500. I don't think they should or will, but if things were to get worse from here, they have the ammunition to go down, 500 basis points.
So every cycle is different. The majority of cutting tends to happen in the first 12 months, and base effects matter, i.e., where you start from gives you a clear indicator about how much room you have to move to the downside. Okay, I think we're going to skip 14. That's the hairline chart that we hit.
Yeah.
Going to 15, historic 2-year trend change, signal rate cuts ahead. This is an interesting one.
Yeah, so I've been taking most of my guidance from the 2-year. The 2-year, I think, has a better handle than long-term rates on where the Fed is going to go. And I also think that long-term rates have rallied a lot already. They can go lower if the Fed delivers more than the 200 basis points of easing. But if you look at this chart from the perspective of momentum, that red line is like a momentum indicator. Very simplistic, but it's just looking at the cumulative change for a 2-year Treasury in a 2-year window, which is basically the life of the 2-year. So as it's kind of rolling along, once the trend in the rate direction changes course, it keeps going until it stops, and it hasn't stopped, and the Fed has only started cutting. So the way to read it is roughly somewhere between 6 months to a year. The bond market realizes that there's only so much further the Fed can raise rates, and then it starts to trade sideways, which is what the 2-year did for the better part of 2023 into 2024. And then now it's broken through its prior low that we saw during the kind of SVB move. And now, if you take this to its final completion, that red line will continue to decline until it starts to form a base, which is probably after the Fed has delivered on the cuts. So that's the way to read it. It's worked for most of the recent easing cycles. Once the 2-year changes directions, it signals cuts are ahead, and most people were ignoring it. I don't know why. I mean, this is like one of the other obvious charts where it's been staring you in the face that the 2 years telling you that lower rates are coming, but people didn't want to believe it either because of their sort of kind of worldview on where we are in the economy, whatever the case may be. But the bond market's been telling you that we can't afford high rates. Fed's going to start cutting. It's only a matter of time. Now that they actually start to do the process, it's only when they finally stop cutting that the 2-year, I think, will hit bottom. And I think that's we've had a kind of a curve steepening bias. We've had the 2-year is the best point on the curve, and that's been the right view in our book.
Gosh, that's such an important point. I've seen so many cycles where you see investors get caught in there. I don't want to call it politics, but just this worldview where, like, I remember this during the 2008 crisis so vividly. It's like the reckoning is coming. It has to come. Just has to come. This equity prices can't stay where they are, and they did, right? And they continue to. And so it's so interesting to look at this from a data-driven perspective. Let me just ask you, what's your base case for where that 2-year yield is going to stop? Obviously, when it went above that historic 5% mark, where do you think this continues to go? Where do you think the 2-year yield finds a bottom?
Yeah, so our official forecasts are very close to what the Fed's going to deliver. So basically 3% and slightly under, like 2.75, 3% is probably where the 2 years moving towards. So it still has about 75 basis points or so to go, 50 to 75 declines. So the 2-year could rally more than the 10-year, where I think the 10-year can be somewhere between 325 and 425. If the 10-year were to break under 325, and that would then create another bull flattening type move, then something must have broken in the economy or financial markets, which again is a possibility. But I think that the fact that the Fed is now getting ahead of it or trying to get on track by delivering these cuts, it's going to be mostly the front end that rallies from here. And we'll have episodes where long-term rates can actually sell off if we get, there's going to be times where data is not going to be always looking that bad. Maybe might improve in Q1 next year, give us kind of this false dawn that everything's fine. And then, we realize that we're still in the slowdown.
All right, slide 16. I think we got through, I don't want to say all of them, but most of them. This is the last slide in the deck. Talk us through what we're looking at right here.
Yeah, so this actually is a great way to kind of end, because we started off with how much the divergence has happened between small businesses and large corporations, and how, in many regards, large corporations have been borrowing at basically Fed funds interest rate levels with a small spread. So what I'm showing you here is the Fed funds rate again, the red line. The black line is the spread, though, not the yield of corporates, but the spread that corporates, the overall index, not just one individual company or industry, but the overall broader index of IG. Spreads are very tight. They're tight.
This is the investment grade options adjusted spread that you're looking at. This is a metric that measures the spread that large
above government rates,
above the federal funds rate.
Exactly. And that spread is near historic lows. It's kind of been bouncing around the lows. And our view is that if rates continue to rally from here, then spread risk or widening risk can start to actually take hold. And that is, if when the Fed's cutting, they're usually cutting because the economy is slowing down, not because the economy is getting stronger, right? And so if that's true, then it probably will flow through to corporations as well. And so then you'll see some credit risk premium come back in, and or credit bonds will not be able to rally as fast as government bonds. And so by default, the spread starts to widen. And so I think that, if the Fed's cutting rates because of the macro considerations that we've laid out here on the labor side, and that it's going to be bumpy from here on out, then credits are too rich on a hedged basis versus govies.
George, it's always a pleasure when you join us. Especially enjoyed this show here today. A slightly different view from a different angle, talking about some of the issues that everyone is concerned with, everyone is focused on, but a different perspective, a different narrative, different data points. Really a pleasure to have this conversation with you. Final thoughts, key takeaways that you'd like to leave our listeners and our viewers with from this conversation.
Yeah, I think that the key takeaways are rates do matter, that we are at a point where it's unclear if the Fed's going to be able to soft land. And so, they're going to try their darndest to try to soft land, which means that they have to deliver on the cuts that are already priced in. And don't underestimate all the financial conditions easing that has already taken place, and it's already been embedded into risk markets. It makes it much more challenging going forward to trade these markets.
George Goncalves, head of U.S. macro strategy at MUFG. Always a pleasure when you join us. Thanks for watching. Thanks for listening. Have a great afternoon, everybody.
What if you could invest in a hard asset like silver and then earn a return in that same asset, bypassing the fiat dollar system entirely? Now you can. Monetary Metals has made a name for itself by generating a yield on gold and silver for their clients over the past 8 years and counting. Now they're offering the first silver bond in almost 200 years with a 12% annual interest rate paid in physical ounces of silver. Available to accredited investors only, investors in the bond receive a fixed 12% coupon on silver paid in physical ounces of silver, plus any silver price appreciation. Over half the bond has already been sold, and the remaining allocations are going fast. Do not miss being a part of this historic offering. Protect and grow your wealth in an asset that has stood the test of time. Secure your spot at realvision.com/metals.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.